Good evening, everyone. My name is Paul Young. I'm just going to walk you through international trade. This is basically looking at exports and imports and trade deficits. So I'm really just going to cover what happened in December 2015 for Canada. Like anything else, I'm going to do a quick disclaimer here. This is one opinion of the numbers. It's up to individuals that are looking at facts and data to actually look out for other people in terms of their perspective, whether that's a bank or different sectors, to get an opinion. I'm just going to give you my opinion from my background in business to kind of tell you what's going on in the sector. Now, in an executive summary at the highest level, four key sectors are basically carrying the strength of exports. They're automotive, forestry, aerospace, and the food sector. Now, if we take them and peel it back, automotive had a banner year in the U.S. That's what's driving exports. Forestry is being driven by a strong U.S. housing market that finally started to rebound. Aerospace, you're seeing an upcycle, and airliners replacing their fleets. Food sector, that also gives you a good indication of consumer spending. A healthy economy means people tend to eat better. Let's talk about some factors that are going to drive things going forward that came out. Canada's ratified TPP. It'll take up to 2 years to implement, but it's been ratified. There's also been a pullback in terms of looking at trade deals with India. The stumbling block right now is they want to get an investment protection agreement in place, so that's something to watch out because India is a growing market that Canada needs to be able to compete more in that market. This particular chart I just wanted to show you is overall exports are up about 3%. That's pretty good considering that the commodity sector, which is a key driver in terms of exports, when you look at the two of them together, you're basically seeing that that sector's down basically 28% for oil and energy, and then about 7% down in the metal ores. So overall, our commodity sector is down significantly, and yet we still were able to get sales up. So the other sectors have kind of countered that. That's something to bear in mind, and that's something I wanted to highlight here. The other thing too as well, we've seen an appreciation, a lowering of the Canadian dollar, so that's what you're seeing with the China, Euro, and US dollars. Why did I pick them? Because about 75, no, I shouldn't say 75, well, good 85% of all exports basically go to 3 or 4 areas. That's why I highlighted them, because that's going to drive the price of goods, how the Canadian dollar is. Deficits between countries, a key area just to focus on, because you're going to hear a lot of rhetoric about that. In order to reduce that trade imbalance, we need to be able to export more goods to those countries, and typically energy is a good area, from oil to natural gas, liquid natural gas. Those are key sectors, but to grow those areas, we need the capacity, and that's where the pipelines come into play. That's where the port development is. That's why there's been huge investments in ports like Prince Rupert that kind of help get exports to market more, and that's been done pretty good over the years, but more is done. So near the end, I'll get in more about government policy, but I wanted to highlight that. So you cannot reduce the deficit down unless you expand exports or reduce the imports down. That's basically how trade works. This kind of gives you an idea of highlighting the key areas in yellow that we have trade deficits within a certain market segments. So it's kind of interesting to look at that, because how do you expand those? Now, what's the issues facing exports going into 2016, 2017? Slower growth. What's also impacting is the Canadian dollar. The Canadian dollar's pricing is based on commodities, and the commodity prices are down, so that's driving the value of the Canadian dollars, which makes our exports cheaper, but it makes imports more expensive. Trade investment deals that have been signed by the previous Conservative government will start to kick in. That's CETA, that's South Korea, that's Colombia. China's got a FIPA agreement, so these things are starting to kick in. It's something to bear in mind. We have a new federal government in play, the Liberal government of Canada. It also has to make a stance on where it's going to take trade for the next 4 years of its mandate. That's to bear in mind. We have new taxation policies, and the reason I bring that in, because those impact costs to companies. That can drive where investments made. That's what you need to bear in mind. Infrastructure. We have a new government, we have a new commitment on infrastructure, so some of that infrastructure money needs to go to support exports. Key quotes here. I picked this one from Chrystia Freeland. She's the Minister of Trade. She's saying the government's going to support exports, so it'll be interesting to see how that plays itself out. I also took a quote from Perrin Beatty from the Chamber of Commerce because he supports TPP. Now, basically, I wanted to give you a good perspective because these are areas that's very important. Exports are a critical driver of the economy. For each $1 billion of exports, it creates 5,500 jobs, and those jobs pay pretty good. That's not something you basically hear about, talk about. The other thing is export capacity is down about 25% where it should be at. If we were able to raise that, that also means we could help put a dent in unemployment, help bring more foreign direct investment in, and that's all part of it. What's going to be clearly understood and what needs to be measured here is what the government's policies will be to drive exports, because exports are critical to GDP growth. And that's something that you need to bear in mind as you go forward and understand the trends. Thank you.